Everyone says index funds are the safe, boring way to build wealth. Buy the S&P 500. Hold it for 30 years. Retire rich. That's the whole pitch. But here's what that advice leaves out. The S&P 500 delivered negative returns for an entire decade. Not a bad year, not a rough patch. 10 full years, 0 gains. If you retired in 2000 with your life savings in an S&P 500 index fund, you ended the decade with less money than you started with. And nobody told you that could happen. That's what this video is about. Index funds are not the simple, safe bet the internet makes them out to be. There are specific, real risks built into how they work. And most people investing in them have never been told what those risks actually are. Right now, tens of millions of Americans have their retirement savings in index funds. Most of them have no idea what's inside those funds. They've been told, diversified, low cost, long term. They feel responsible. They feel like they're doing the right thing. And they probably are doing something reasonable. But reasonable is not the same as risk-free. And the risks that exist inside index investing are not random. They are structural. They are predictable. And they hit people at exactly the worst possible moment. If you have a 401k, a Roth IRA, or any retirement account, even one you barely think about, this directly affects you. Let's start with what an index fund actually is. When you buy an S&P 500 index fund, you are buying a tiny piece of 500 large American companies. The fund automatically mirrors the index. It doesn't pick winners. It holds everything. The idea is, if the US economy grows over time, so does your investment. Simple, logical, basically true, over very long timelines. But here's the part people miss. The S&P 500 is not equally split between 500 companies. It is weighted by size. The bigger a company, the more of your money goes into it. Right now, just 10 companies make up nearly 40% of the entire index. Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, a handful of others. That means if you put $10,000 into an S&P 500 index fund today, roughly $4,000 of it is sitting in those 10 companies. The other 490 companies share the remaining $6,000. So when someone tells you that index funds give you broad diversification across 500 companies, they're technically correct. But they're also misleading you, because 40% of your money is not diversified. It is concentrated. In tech, in a handful of companies that are all exposed to the same market forces, the same regulatory risks, the same economic cycle. Here's the most concrete proof that this matters. The S&P 500 in the year 2000 looked a lot like it does today. Tech stocks had exploded in value. A handful of companies, mostly tech, had grown so dominant that they made up an outsized share of the entire index. People poured money in. It felt safe. It felt diversified. It felt like smart, long-term thinking. Then the dot-com bubble burst. Over the next 3 years, the S&P 500 lost roughly 40% of its value. Then it recovered. Then 2008 hit, and it crashed again. Another 40% drop. By the time the decade ended, an investor who had put $10,000 into the S&P 500 at the start of 2000 had $9,089 by the end of 2009. 10 years of patience. 10 years of contributions and discipline. And they ended up with less money than they started with. That is the lost decade. And it is not a theoretical edge case. It happened in your parents' lifetimes. It happened to people who were doing everything right. The reason it happened is exactly what's happening now. Too much concentration at the top. The same kind of companies. The same kind of story about why this time is different. Now here's where it gets more uncomfortable. The lost decade wasn't just painful for people still accumulating wealth. It was potentially catastrophic for people who had already retired. And this is something almost nobody talks about. When you are saving money, market crashes are survivable. You keep contributing. You buy shares at lower prices. When the market recovers, you benefit. The technical term is dollar cost averaging, but the simple version is you get a second chance. But when you are retired and withdrawing money every month to live on, that second chance disappears. Here's why. Imagine two retirees. Both have $1 million saved. Both put it in the same S&P 500 index fund. Both withdraw $50,000 a year to cover living expenses. The only difference, one retires in a good year, the other retires in a bad year. Retiree A sees strong gains in the first few years of retirement. Their money grows even as they withdraw from it. By the time a downturn hits, their portfolio is bigger and more resilient. Retiree B retires in a year when the market drops 30%. They're forced to sell shares at the worst possible price just to pay their bills. Those shares are gone. They cannot recover. Even if the market fully rebounds in 3 years, Retiree B sold those shares at a loss, permanently. Research by financial economist Wade Pfau found that roughly 77% of a retiree's final outcome can be explained by just the first 10 years of returns. Not the average returns, not the long-term trend. The first decade. Two people with identical savings, identical strategy, identical discipline, completely different retirements. The only variable was timing. And timing is not something you can control. Here's the second risk that's almost never discussed. The S&P 500 is a backward-looking index. It doesn't predict the future. It rewards companies that already got big. Think about how it works. A company gets added to the S&P 500 after it has already grown enormous. By the time it's in the index, the massive growth has already happened. By the time it represents 5% or 7% of the index, it's already at a high valuation. And high valuations mean one thing. The price people are paying already reflects a lot of expected future growth. There's less upside priced in, more downside risk if expectations aren't met. In 2025, the top 10 stocks in the S&P 500 traded at price-to-earnings ratios significantly higher than the other 490 companies. Translation: investors are paying a premium, a very high premium for those shares. Now, those companies might keep delivering. They might be worth it. But the bet you're making when you buy the S&P 500 today is not the same bet you were making in 1990. In 1990, the 10 largest S&P 500 companies made up about 20% of the index. Today, they make up nearly 40%. You are not buying the same product. You are buying an increasingly concentrated bet on the continued dominance of a small group of tech companies. That might work out perfectly, or it might look a lot like 2000 in hindsight. So how did index funds end up carrying these risks while being sold as the safe option? Here's how it happened. For most of the 20th century, individual investors were at a huge disadvantage. They paid high fees to professional fund managers, and most of those managers couldn't beat the market anyway. Study after study showed that actively managed funds where experts pick stocks, underperform simple index funds over the long run. So the message became, stop paying for someone to manage your money. Just buy everything. The market always goes up. That message was largely true and genuinely helped millions of regular people invest smarter. The low fees are real. The evidence against active management is real. But somewhere along the way, the nuance got stripped out. The message shifted from index funds are a smart, cost-effective strategy to index funds are safe. Those are not the same thing. No investment that can lose 40% of its value in a single year is safe. No investment whose returns are increasingly driven by 10 companies is safe from concentration risk. And no investment strategy that ignores when you retire is safe from the sequence of returns problem. The financial industry has a word for this kind of oversimplification. They call it marketing. Here's the counterintuitive part. Index funds are almost certainly still the right choice for most people as the core of their long-term strategy. That's not what's in question. What's in question is whether people understand what they actually own. And the data suggests they don't. In early 2025, the S&P 500 dropped nearly 15% in just a few months. Apple, Nvidia, and Tesla led the decline. 3 companies. And they dragged the entire index with them, because those 3 companies alone represent a massive chunk of the whole thing. People who thought they owned the market discovered they'd actually made a concentrated bet on a handful of tech companies. And consider this counterintuitive data point. During the lost decade, that 10-year stretch where the S&P 500 returned negative, emerging market stocks returned nearly 10% per year. U.S. small-cap stocks returned over 3% annually. Real estate investment trusts returned over 10%. Investors who held only the S&P 500 lost money over 10 years. Investors who held a diversified global mix made money. The safest sounding investment wasn't the safest investment. The product sold as buying the whole market was actually buying one concentrated slice of it. That gap between what people think they're buying and what they're actually buying is where the real risk lives. The story of index investing is mostly a success story. Fees came down. Regular people got access to markets. Wealth got built. But the story got simplified in a way that created a specific kind of blind spot. Millions of people are now holding retirement savings in something they believe is diversified, when it is increasingly concentrated. They believe it is safe, when it is exposed to sequence of returns risk that could define their entire retirement. They believe the 10-year average return tells them what they'll experience, when what actually matters is the decade you happen to retire into. Index investing was sold as the solution to the problems with active investing. And it was. But it was never the end of the conversation about risk. It was just the beginning. The question isn't whether index funds are good. The question is whether you actually understand what you're holding, and whether your plan accounts for the specific ways it can fail you at the worst possible time. Most people don't, and the financial system benefits from keeping it that way.